Here we go again, another video about interest rates. Interest rates are going up again. What does that mean to you as a property investor? I know I've done like 5 of these videos this year already, but there's been more changes by the Bank of England base rate than the last 5 years put together, and we're expecting another rise on the 3rd of November 2022. We'll see if my prediction's right on that. How do you actually approach this as a property investor, and can you still make money in property today? So how does it actually impact us as investors? Well, one of the most obvious ways is through cash flow. One of the reasons, and people think it's the main reason, but it's not, but more on that later. One of the main reasons is cash flow, i.e. you rent out a property to an individual, and for the privilege of that, they pay you a rental income on your home. One of the key benefits to property over other asset classes is the fact that you can leverage. And what I mean by that is you can use other people's money for all of it, but mostly the mortgage, which in buy-to-let terms is usually 75% of the property purchase price. But if the interest rates go up, the cost of that mortgage, the cost of that debt also goes up. So if you think about, let's say you bought a property for, I'm going to make the numbers easy, 125,000 and you borrowed 100,000. Again, just to keep the numbers simple, if you were paying 2.5% interest on that 100,000 each year, you would be paying around 2,500 a year, or £220 per month. So if you're renting out a property for £700 a month, then you're making a decent amount of profit. But let's say it goes up to 7.5% interest. For that same £100,000 borrow, you're now paying £7,500 a year, just on the interest. And if you're renting out at £700 a month, £8,400 a year, suddenly all of that profit margin has dropped significantly. So if you're investing in buy-to-let property in order to quit your job, that just got harder. Another pressure point that's put on with this is on the capital value of properties. And this is really in line with what can people actually afford? Because what tends to happen is as interest rates rise, rents also rise because the cost of that is passed on to the tenant. But a lot of people are really struggling to actually pay to survive right now. The cost of living has gone up, inflation's crazy high in the first place, and then really, can people eat, pay their bills, and pay their rent or mortgage? Well, it's difficult already. If you just whack that onto the tenant, are they going to be able to afford it? The reason this is really important is if less people can actually pay more, then demand for property drops a little, theoretically, and then nobody can buy the properties, which of course means there's less demand than supply, which reduces the capital value of the property in the first place. In principle, and I'll link back to that. But first of all, why? Why are interest rates going up so dramatically? This is the thing that absolutely blows my mind. People are like, November 3rd, here's my prediction, by the way, and it is just an opinion. I think interest rates, the base rate, is going to go up from 2.25% to 2.75%. So I think there's going to be an increase of 0.5%. We'll see if I'm right, we'll see, and we'll go from there, but it is going up. And then people will get to the 3rd of November or the 4th of November, and the media will go, oh my God, this is the end of property and the end of days. We're going to have a 40% drop. It's like, shut the fuck up. You don't have a clue what you're thinking about. But people do watch it and they're like, oh my God, interest rates have gone up again. It's like, yes, it's meant to. In fact, every single increase that has happened this year has been planned. Okay, now the variance in what it goes up by is the thing that's discussed, but it's been planned since the start of the year. Now here's how it works, just a very simple explanation, or I'll try to keep it simple. Inflation. Inflation essentially is when there is money flooded into the market, which has happened, by the way. The government has been printing copious amounts of money in the world. Now think of supply and demand. If you're hungry right now, really hungry, and there's a plate of food there, only one plate of food, how much are you willing to pay for it? Whatever the number is in your head. Now, presume you're still really hungry, but now there's 100 people in the room with 100 plates. how much are you willing to pay for it? It's going to be a lot less because there's a lot more supply to satiate your hunger. Obvious, right? And that happens with money as well. When there's this amount of money in the world, it has a certain amount of value to it. But then when you print a load of that money, and there's so much more money in circulation now, it's called quantitative easing, how valuable is that money? Well, it's not as valuable, so it drops. What also happens at the same time as this is that supply and demand is impacted. So if we look on this side, we've got demand that has gone up, but supply cannot keep up with it. And what that means is prices dramatically increase. We rush to provide the supply, and so prices get out of hand, therefore inflation. Currently, it's around 10% inflation. Now, the actual reality is it's quite a bit higher, by the way. But the number one way of bringing down that inflation is to increase interest rates. And the idea of increasing these interest rates is it makes it more appealing for people to save their money, stop spending the money, and therefore recalibrate that inflation to a more manageable figure, which, by the way, is around 2.5% to 3.5% per year. I don't really talk about politics very often on the channel, and I'm not really going to do it, but the current government being a little bit of an idiot, frankly. And because of being an idiot with all these sudden tax changes and everything like that, the trust in the pound has been dramatically impacted. In fact, it dropped by about 22%. Fortunately, not as an individual perspective here, by the way, because the changes were good for me as an individual, but for a country perspective, fortunately, it's been reversed. So there's now more confidence in a pound. But when the world looks at the country and goes, you're run by idiots, that's going to have an impact. So if the trust in the pound goes down, it drops in value. Now, you might think, well, what does it matter? A pound is a pound is a pound is a pound, right? Well, yes, internally, as in the same country. But what you need to realize is that as a country, we import quite a lot of things. And so when we import things, that means we bring things in from other countries. Everything is pretty much pegged by the leading currency, which is the US dollar. So the US dollar hasn't dropped, but the pound has dropped. What that means is you now need to spend more pounds to get a US dollar. And if everything we import is pegged against the US dollar, it means we have to spend more to import it as a business, and then that is passed on to the consumer, which again is forced inflation again. Hopefully that kind of made sense to you. Amy? That makes sense. So, great, thanks Jamie. My money is worth less. The cost of borrowing is gone up. What can I actually do about it? Well, let's go through some scenarios. Let's say you're a buy-to-let investor and you've already got your mortgage fixed in place. Well, if you've already got it fixed in place, great, let it run its course. If it's going to be up in the next 6 to 12 months, I'll go through that in a while, because interest rates might go high. Just to let you know, by the way, it's also planned to start reducing next year. Planned. And it will happen if we carry on going the way we're going. Just to put your mind at rest and take the media shit out of your head for a second. So if you've got it fixed for a while, you don't need to do anything. You're absolutely fine. What if you are a new investor, or indeed, maybe your mortgage is coming up and about to go to a variable rate? Now, caveat here, I am not qualified, nor should I be seen as a financial advisor at all. This is just my opinion, and it's what I am doing personally. Okay? For me and my investors that tend to follow suit, but not financial advice. There is something that not many people talk about, and it's called the DVR. DVR, or discount variable rate, is something that most people don't talk about. So how do mortgage actually get priced? Well, first of all, you've got your baseline interest rate, which is the Bank of England. Then you've got a bank's cost. So say the base rate at the moment is 2.25% at the time of filming. It might go up to 2.75%, maybe 3%, who knows? Then what happens is you've got the cost. Let's call it another 1%. So now we're at 3.25%. And then the bank needs to put their profit on top to actually make money from lending to you, right? That is what is fairly obvious, but what you might not know is a discount variable rate mortgage, number one, is not fixed in any way. Number two, it tracks at between 1% and 4% above base rate. So sometimes the mortgage companies or the lenders aren't actually making money, but it's tracked. So yes, it can go up and down, but it's a lot lower. And I'll talk about numbers in a second. And number three, there's very rarely any early redemption charges. What that means is if you want to pull out in a year of that mortgage, there's usually no costs associated with it. Why does all that matter? Well, this is my strategy with properties that I'm still buying today. And yes, I am still buying today. First of all, what happens is there's an increase in time that it takes to sell a property. The reason that's important is it doesn't exactly affect the value of the property, whether it goes up and down, but it does affect your negotiating power. So what it means is in the last couple of years, in order to get a £100,000 property, you've probably been paying 105 to 110,000 to get it because competition's been so high. But now as the market slows, if somebody's motivation is speed, they're no longer starting to get that on estate agencies, so they might actually sell it for 100 or indeed get a bit of a discount, 4 or 5 grand off. Great opportunity if I'm buying cash. If it's just a great solid long-term investment, here's what I personally am doing. I am not fixing it on a mortgage. I am going on a discount variable rate. The reason for this is if I'm looking at a fixed mortgage right now, I am going to be paying between 5.5% and 6.5% interest rate. I don't want to do that, especially as I strongly believe towards Q3 of next year, the interest rates are going to start coming down. So instead, what I'm doing is buying in my company, discount variable rate, which at the point of filming this is 4.19% interest with no early redemption charges. What I'm then planning to do is buy it like normal and then refinance the property towards the end of next year on more favorable rates. Now, here's the great news. If it isn't more favorable for whatever reason, I can just wait another 6 months, no problem whatsoever. The only risk of this is if we think interest rates are going to skyrocket to crazy amounts and people go, I remember the days when interest rates went to 15%. And they did, by the way, for a week. And people seem to miss that out. Interest rates in the 1990s, it went up to, yeah, for 1 week it did that. I have no concerns about that happening whatsoever. So my strategy and my opinion, not advice that I would share, is look at discount variable rates. Talk to a broker. In a personal name, by the way, it's 3.2% at the time of filming. So if you're a lower income taxpayer and maybe you're considering buying in a personal name, you're going to get that reduction. So the costs are still very favorable. Yes, there's a bit of risk in fluctuation of those interest rates, but I'm okay weathering that storm and then refinancing on a 2 to 5 year fix in a year's time. So what's likely to happen in the next few months with property? Well, obviously, well, not obviously, but interest rates are likely to increase. And until inflation starts coming back down, which they are taking actions against, then interest rates will have to continue to increase. Do I think this is going to collapse the market? I read something the other day. It could collapse up to 40%. The media. The quicker you realize the news and media is not news, the better. It's propaganda. Like, their only motive is not to serve you information in 99% of situations. It's to sell the media to you, sell your attention so that advertisers pay them a load of money. You need to understand that if you don't understand the commodity, you are the commodity. Rant over there. Of course, I don't think that at all. Do I think the market's going to slow down? Yes. Is that bad? No, we absolutely need it. Property prices have been increasing at 1% a month almost. It's 23%, I think it is, maybe 22% in the last 2 years. That's crazy. How could we possibly carry on going at that rate? The average property price right now is 300,000. It would be 600,000 in just 4 or 5 years. That is crazy when salaries are not keeping up with that. I actually see it as a really good thing. And the great thing is is a slowdown in the growth is not a collapse in the growth. Do I think there's going to be a 10-15% drop over the next 6 to 12 months? No. What I think is that actually capital growth is going to be more like 4 to 5% over the next 12 months rather than 9, 10, 11, 12%. And that slowdown allows a great opportunity for those people that are going to take action and actually invest and back themselves. And you know, a lot of people concerned about a recession. A recession does not correlate all the time to a property collapse. In fact, since the 1950s, just so you're aware, there's been 6 recessions. In those 6 recessions, there's only been twice that property prices went down. One of those is 2008, which was a property crisis, i.e. the property crisis, subprime mortgages that went on over in America and the rest of the world caused the recession. So the fact that people think recessions cause drops in property prices isn't actually correct. And I always go back to the fundamentals, and I'll conclude with this, that there is a shortage of housing. The housing crisis in the UK is that by the end of 2022, there are 1 million more people looking for a property that isn't there. There's a 1 million unit housing shortage. So yes, take account of the interest rates. Yes, be strategic in how you're going to approach this. And yes, maybe you want to start being aggressive with your cash purchases. That's exactly what I'm going to do. But hey, this is just one man's opinion. I hope this has been valuable, insightful, and educational. If you want more videos like this, let me know in the comments and I'll do more about interest rates, inflation, and my opinion on this. If you're new to the channel, it will help me tremendously if you lightly tap the like button and the subscribe and the notification bell, and I'll see you in the next video.